Now the time to add equities to your portfolio. Joining us are Matt Roddy, Vice President and Portfolio Manager at Rockland Trust, and Kevin Norris, President of Univest Wealth Management. Guys, good to have you here. Kevin, I want to start with you because you like Exxon, and I'm wondering if that's a way to ask the broader question here, that the worst is over. I mean, if you're willing to buy Exxon, do you think the worst is over for oil, and hence, because there's been so much correlation, the worst is over for the markets?
Well, I think the worst is behind us. I don't think it's completely over yet, but I think, oil prices are still under pressure. We're capping oil output, or there's an agreement to cap oil output at record levels. So that's not going to help the oversupply problem. It's just going to exacerbate it a little bit more. We have to get some kind of production cuts out of OPEC. But we like Exxon from the flight to quality perspective. It's a solid integrated oil producer. Solid balance sheet, 10% debt to capital ratio, and it could be the beneficiary of a shakeout in the energy sector. Companies that are not going to survive this kind of a downturn in energy prices, a company like Exxon, a quality company like Exxon, is going to be able to do that. And by the way, it's paying a dividend, still is buying back shares, although it's buying back less than it has in recent years. So they've got the good, solid cash flow to survive this kind of a downturn in oil prices. And, I guess, candidly, I don't think it's going to last forever, that we're going to stay at $20 or $25 or $30 a barrel. I think oil prices will rebound, but not to $100 levels yet.
Got it. All right, Matt, you like Alphabet, what we used to call Google. Why are you buying that here at this point in the market?
Well, we've owned Google since early last year. We've done very well with it, but really, lately it's had about a 10% pullback. It's a little bit more of a pullback than the broader market. Google's a company trading at 20 times earnings, but it's growing those earnings at 17% a year for the foreseeable future. The market as a whole is trading at 15 times earnings and really with no growth. So they've also got a new CFO in place who's doing a good job of reorganizing the company. If there's really one knock on the company, it was how are they managing the finances and were they good stewards of the investors' capital. With her in place, she's reorganizing the company between the core business as well as the the moonshot businesses, and she's doing a good job. I think there's going to be more clarity around that, and that's a free option on the stock. I mean, we'd buy the stock if there was none of that. But when you add those in, that might be more options.
I mean, tell me about McKesson in the healthcare space, which is down 32% over the last year. Why are you stepping in there?
Yeah, I mean, when we're looking at beaten down growth companies that are non-cyclical. We look at McKesson; it looks like a great value, down 35% over its highs of last year. It's really been a company that's been tremendously run. It's the best in its space in the drug distribution space, pharmaceutical distribution. Better than AmerisourceBergen in our opinion, and Cardinal Health. Trading at 11 times. That's the cheapest it's been since the financial crisis. A lot of the noise around the stock has been around what's going on with some of their customers. They've been merging. CVS bought the Target in stores. Those are both.
You know what, guys, we got to cut you off. I'm so sorry, Matt and Kevin, because we have some breaking news. We got to get to Eamon Javers. Apologies, guys. We'll have you back. Eamon.